Welcome to the Lane Gorman Trubitt COVID-19 Financial Webinar Series. In this series, our accountants and advisors will provide you with information to make sure your business has the tools it needs to survive the 2020 coronavirus lockdown. This webinar is about how a small business can take advantage of Paycheck Protection Program loans to help keep them in business until we are all back to work. It was recorded live from a Zoom webinar on April 3rd, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have any questions, please feel free to email us at askus@lgt-cpa.com, and we will get back to you as soon as possible.
Hi, I think we're about ready to get started. While there's still some folks that are working on joining, let's go ahead and get this webinar going. So thank you for attending our webinar today. We're very excited to have such a large group with us. My name is Colin Kanalakis. I'm a partner with Lane Gorman Trubitt and joined by several other professionals within the firm. A little background on our firm. LGT is based in Dallas, Texas, but serves clients throughout the United States. We started back in 1950 and we're celebrating our 70th anniversary working with small and medium-sized businesses, servicing accounting, audit, tax, and consulting services. We'll be focusing today's webinar on the two SBA loan programs, which are on everyone's mind. The Payroll Protection Program, more commonly called the PPP program, and the Economic Injury Disaster Loan Program, more commonly the EIDL program. Our presentation group today is led by Denver Todd, Senior Tax Manager, and Ryan Cole, Tax Partner. Matt Peck and Matt Dobay, Tax Partners, and I will be assisting the presenter group and will help with questions that come up during the presentation. If you're not familiar with Zoom, in your Zoom screen, there's a Q&A function if you go to the bottom of the screen. While we will be answering most of your questions during the presentation, there's going to be some that we'll go ahead and answer in the question and answer screen. We will not be able to answer all due to the expected volume of the questions that will be asked, so we apologize if we don't get to your questions before the end of the presentation. After the Zoom webinar is completed, you'll get a pop-up with a basic survey. Once you complete that survey, you will have access to download the slides from this presentation. Also, at the end of the presentation, we'll provide a link to our COVID-19 financial update resource page. This includes all of the presentations and blasts that we've sent out to our clients in our database. So if you can make sure you get out there and look and see if there's any other questions that are answered from our other resources. Now I'm going to hand this over to Matt Dobay, and he's going to give us an update on a webinar that will be set up for next Wednesday. Thank you, Matt.
Thank you. Again, thank you for joining us. For those of you that have questions on tax law changes in the CARES Act, LGT will be hosting a webinar next Wednesday, April 8th at 3 p.m. Central Time via the same Zoom platform. An invitation will be sent out next Monday, so please keep an eye out. One time-sensitive item that I would like to touch base on now relates to the change in required minimum distributions. The CARES Act has waived the RMD requirements for 2020. If you've taken your RMD already for the year and would like to reverse it, you may have an opportunity to, provided you recontribute the funds within a 60-day window. Please contact your financial advisor if you'd like to take advantage of this possibility and if you're still within that 60-day window. With that, I'll pass it on to Matt Peck, who has some additional insight on other pertinent information.
Thanks, Matt. Before we get started, I wanted to make a quick reference to two other issues that could be time sensitive. Effective yesterday, 2 paid leave acts became mandatory for employers of less than 500 employees. The Emergency Paid Sick Leave Act covers 80 hours paid leave for employees unable to work due to virus-related issues. Then there's also the Emergency Family and Medical Leave Expansion Act, which covers up to 10 weeks paid leave for employees unable to work from home or work in the office due to the need to care for a minor child related to COVID issues. there's a 30-day grace period for the implementation of these policies, but they are or were to go into effect yesterday. But the key point to them is, while they are mandatory, they can be funded or will be funded directly with payroll tax offset. So you would reduce your payroll tax deposits for the amount of the benefits you're paying under these plans. Your payroll tax provider should be able to tell you more about this, or if not, you can reach out to your LGT advisor. But we will cover more of these type items next week on our webinar on Wednesday at 3. With that, I'm going to turn it over to Denver to talk about the Paycheck Protection Program, which is opening up today with the banks. Thanks.
Thank you. Thank you, Matt. Okay, I'm going to be talking about the SBA loans that a lot of you have probably been hearing about in the news. So on this chart right here, I have a little bit of a comparison of 3 different SBA loans that you can receive. The main 2 that we're going to be talking about today is the Paycheck Protection Program loan, or the PPP loan. This was part of legislation that was passed and signed by the president last Friday. It has been moving very quickly, and there have been new interpretations and a revised form that actually came out last night. There was $349 billion allocated to this program, and it's a first come first served basis, so you want to apply as quickly as possible to avoid the funds running out. And then there's also the Economic Injury Disaster Loan, or the EIDL loan. This is just the expansion of a prior SBA loan that has been out there because of the COVID-19. Okay, I'm going to talk a little bit about the differences between the 2 loans, and then I will jump into more information about the Paycheck Protection Program loan. So some of the main differences are, for the PPP loan, you're going to have to apply through a lender that is approved by the SBA, whereas the EIDL loan, you're applying directly through the SBA, and you can do that online. The maximum loan size for the PPP loan is $10 million, but there's actually the calculation to calculate the loan amount is based on your average monthly payroll. So it's a little complicated, but we'll get into that. The guarantee needed, there's no guarantee need for the PPP program loan, and there's no collateral, which is great. The duration, when the bill was originally proposed and signed and whatnot, it said the term could be up to 10 years, but Treasury's come out and clarified that it'll be a 2-year loan. The interest rate was going to be up to 4%. Last Monday or Tuesday, guidance came out from the SBA that would be 0.5%. Well, last night they've changed, and it's actually going to be 1%. Like I mentioned before, this is very fast moving, and it has been changing a lot recently. There's no advance grant available for a PPP loan, but there is for an EIDL loan. That's one of the good things about the EIDL loan. If you go that route, you can potentially get up to $10,000 within 2 to 3 days of applying. One of the main things that a lot of people are talking about with the PPP loan is there is forgiveness available. And as long as you use the loan proceeds for eligible expenses, it is possible that the entire loan can be forgiven. And we will get more into that. And one of the main questions that a lot of clients have been asking, can you apply for both? Yes, you can, but the loan proceeds cannot be used for the same type of expenses. And I will show you the application, the latest that's out for the PPP loan, in a minute or 2, and you'll see you have to actually mark on the application what you're going to be using the proceeds for. Okay, so we're going to talk about the Paycheck Protection Loan first. We're going to go through a little bit about the application. We're going to talk about the eligibility, what businesses can apply, what are the key terms, how much can I borrow, what can the funds be used for, and then how much a loan will be forgiven. Okay, so the application. Starting actually today, small businesses and sole proprietors can apply through an authorized SBA lender. That's why it's very important to apply as soon as possible, because as I mentioned before, there's only been a certain amount of money allocated to this program, and they said it's first come, first serve. And then starting next Friday, independent contractors and self-employed individuals can apply through their approved SBA lender. There's a little confusion here because sometimes self-employed individuals can be interpreted as a sole proprietor. There's no guidance out there, but I have heard rumblings that the sole proprietors would be ones that have employees versus independent or self-employed individuals would have no employees. But regardless, it's worth it to contact your lender and see what their thoughts are, because ultimately they're going to be the ones that have to approve the application. And another question that's come up a lot is when you have multiple entities, do you apply as a group or do you apply individually? The application is going to be per business tax identification number. So if you have 2 legal entities and you're filing separate tax returns, you're going to have to do 2 separate applications. Okay, here is the borrower's application form that came out last night around, I think it was 7 or 8 p.m. through Twitter on Steve Mnuchin's Twitter account. So this application here, what I wanted to highlight is the purpose of the loan down at the bottom. You have to check what purpose you will be using the loan for. And if you are also going to apply for the EIDL loan, you cannot use those loan proceeds for the same purpose that you will be using this loan for. Okay, so let's talk about who is eligible. The borrower must have been in business on February 15th, 2020. You must have paid salaries or payroll taxes for employees, and you must be a business or a not-for-profit and have no greater than 500 or fewer employees. And there is it is worth it if you do have over 500 employees for the entity that you're applying for to check and see if your industry might have an exception where you can actually have a higher threshold of employees. Okay, so the definition, what are employees? So employees are full-time, part-time, other basis, and employees of their affiliates. So other basis would be if you have employees through a PEO, you're leasing employees, or you're using temporary employees through a temp agency. And on the next slide, we'll talk a little bit about the affiliation rules. But if you have, let's say you are a business owner and you have 2 different entities and each of those entities have employees, it is likely you're going to have to count the employees of both entities when you're doing each separate individual application to see if you are over or under the 500 employee limit. So the SBA affiliation rules, generally business concerns that are commonly owned or commonly controlled are treated as one, even if separately organized. These rules can be waived for franchisees or if you are in the food industry. And if you are, when you're doing your application, if you do have over 500 employees, it's worth it to look into these affiliation rules to see if you might be able to get out of the 500 rule where you're not having to include affiliates when you're counting your employees. Okay, so let's go to the key terms. As I mentioned before, the interest rate is going to be 1%. It's going to be a 2-year term for the balance that is not forgiven. Because what's going to happen is you'll get a loan, and then if you don't use the loan proceeds for all the eligible expenses, you're going to owe what is not forgiven. There's no collateral, no personal guarantees, no prepayment penalties, or closing costs. And as mentioned, a certain portion can be forgiven. You're going to get an automatic 6-month payment deferral on the balance, but interest will still accrue. And what a lot of people have been asking about, do you have to go seek credit elsewhere before applying for this loan? You do not. And there's no credit worthiness assessment. because the government is backing these loans 100%, they're trying to get the money as quickly as possible into the hands of the businesses. And then on the back end, to be able to get the loan forgiven, you're going to have to provide additional supporting information to verify that you actually use these expenses for the required purposes. Okay, so let's assume your business is eligible. Let's see how much loan amount that you can receive. In general, it's going to be a lesser of 2 times the borrower's average monthly payroll costs, or $10 million. So a lot of people are going to ask, well, how do you calculate the average monthly payroll costs? And what is the time period? There's been a little confusion on the time period. When the statute that was signed by the president last Friday and the act that went into law, it said the 12 months prior to the date on which the loan was made. So a lot of people are about to apply for this loan in early April. So the 12 month prior to the date of the loan, and if you receive the loan in April, you would think it would be April 1st, 2019 through March 31st, 2020 for the average monthly payroll costs, where you do the calculation. Well, the application actually says most applicants can use the 2019 average monthly payroll cost for doing the calculation. And the guidance that was released last night actually spoke to the lenders and stated that you would want to use the preceding calendar year for your average monthly payroll cost calculation. And I'll mention this, with the slowdown in a lot of businesses, it's probably more beneficial to use the 2019 numbers, because you're going to usually have, or most likely have, higher pay in that period, which will then allow you to get a greater loan amount. And if you are not in business in the early part of 2019, you will have to use the average monthly payroll cost for January 1st through February 29th of 2020. Okay, so on the previous slide, as I mentioned, it's 2 times the borrower's average monthly payroll cost. So let's go see what payroll cost means. Per the statute and the guidance that's out thus far, payroll cost is payments of compensation to employees for wages, commissions, salaries, not to exceed an annual rate of pay of $100,000. Then it's cash or tip equivalents, paid leave, separation or severance, group health benefits and insurance premiums, retirement, state and local employment taxes, which would be what's paid to the Texas Workforce Commission. And then if you're a self-employed taxpayer, as I mentioned before, you will most likely be applying next Friday. Then you'll also be able to include the net earnings from self-employment up to $100,000. Okay, so let's talk about what is not included. Compensation for individual employees in excess of the annual rate of $100,000. So if you have an employee that is paid $150,000, you would only get to count the first $100,000 in the calculation. You would not get to count the additional $50,000. In the guidance last night that was released, they also stated that federal employment taxes imposed or withheld between February 15th, 2020 and June 30th, 2020, including the employees and employer share of FICA and Railroad Retirement Act and income taxes required to be withheld from employees, would not count. This looks like this is mostly going to affect on the back end when you're applying, you're listing out the expenses that you're applying for forgiveness on. It looks like it's possible that you might not be able to include the FICA taxes for the employees or the withholding on the employee's pay. Okay, you will also not be able to include qualified sick leave or family emergency leave wages. Just to mention, when you're applying for reimbursement, it uses the same definition for payroll costs as it's being listed here. The qualified sick leave and family emergency leave wages, that's not necessarily going to apply when you're calculating your loan amount, because you're likely going to be using your 2019 numbers. But when you're applying for forgiveness, some employers will probably be paying qualified sick or family emergency leaves under the act that just went into place on I believe it was April 1st or April 2nd that Matt discussed at the beginning of the presentation, you would not be able to include those wages because when you file your payroll tax return, you're going to get a payroll tax credit, and they just don't want you to be able to double dip. Okay, so let's do an example. Business A had 1.2 million in wages, commissions, and salary in the prior 12 months. The average monthly payroll costs are 100,000. Business A is eligible for a PPP loan equal to the lesser of 250,000 or 10 million. The 250,000 was calculated by taking the 100,000 times 2.5. Okay, so now we have our loan amount. What can we use the funds for? The acceptable use of funds, you can use it for payroll costs that we previously defined. You can use it for interest payments on mortgages. You can use it for rent payments, utilities, and interest on any debt obligations that were incurred before February 15th, 2020. This question came up a lot recently. What happens if you don't use the funds for what they want you to use them for? Well, last night they issued guidance and stated that you would obviously have to repay those funds back, but then if you knowingly use the funds for unauthorized purposes, there can be additional ramifications to you. And with that, I'll turn it over to Ryan as he's going to take over from here and talk about the loan forgiveness.
Thank you, Deborah. I'm going to proceed with the loan forgiveness portion of the PP program, and then we're going to follow up with the EIDL, some kind of provisions for that. One of the items we're going to talk about, well, under the PPP, if the loan is used for the intended purposes for the first 8 weeks of payments, the loans will be forgiven on a tax-free basis. And most of those, the actual defined costs were going to be payroll costs as they were defined in previous slides, but also under section 1102, I believe, of the payroll protection program, and also interest on mortgages incurred before February 15th, 2020, and rents, and this is important, rents enforced prior to February 15th, 2020. So you need a lease in place, and also certain utilities. So what this is really, and we'll kind of get back to this, is from the forgiveness portion. Again, if we're talking about this, we have a item that you can get loan proceeds for, but then also, which everybody's encouraged about, is getting loan forgiveness for. What we found out at around between 6 p.m. and 8 p.m. last night is they've kind of fine-tuned some of these items as they're really focusing on 75% of the costs related to this loan forgiveness being appropriated to payroll costs. There is as I mentioned in the last 3 bullet points there, that you have interest, rents, and utilities. That encompasses the remaining 25%, which would be essentially non-payroll costs. So we can kind of walk through this, but it's going to walk through the same kind of items that Denver had in his payroll costs, and how we kind of determine what the loan proceeds are. But we also, you cannot have a loan proceed, you cannot have loan forgiveness in excess of your loan proceeds. That only would make sense. But at the same time, there may be some items that you are not allowed to have loan forgiveness for. And as I may get ahead of some of those slides, I'll just preview it to you, as if you may have a reduction in employee count and or employee wages. So the first item I think we'll talk about is in employee wages. So business A had 1.2 million wages or commissions and salary for the first 12 months. And they essentially have a monthly payroll cost of $100,000. Under the payroll protection program, they're available for 250,000 or 10 million. It's the lesser of the two. But during the first 8 weeks, they borrowed the 250 just based on their payroll costs. And if their payroll, it's incurred upon the lesser of the two. So if it incurs payroll costs lesser than, or let's just say all encompassing the buckets I had mentioned previously, payroll costs, rent, mortgage interest, and utilities, if they fall under the 250,000, then the remaining 40,000 will not be forgivable, and it's due upon the remaining balance of the loan. And I'm sure they're in the slides, but there were some guidance as you could defer payments for 6 months. There were some guidance in Denver's slides previously as that you could defer payments 6 months. It originally was 6 to 12. I think they, with last night's guidance, they provided that 6 months is the best deferral period. And then the amount of loan forgiven, it will be reduced, as I mentioned previously, about by if you reduce employees during this 8-week period. So it's really an 8-week period beginning on the date that you receive the loan proceeds, and then starting on the date that you receive those loan proceeds, and then that 8-week period. There have been some questions as to, well, what if we have a cutoff period in between payroll periods? We don't necessarily know the immediate question. I know there are also questions as we don't want to have a loan outstanding that we are not really able to have loan forgiveness for, at least to the extent that we anticipate that. But our thoughts are costs incurred and costs paid. So it's really going to be a cash basis. And from what the items that we're reading internally, well, you can cut salary, reduce salary for some employees. But again, that being said, and we'll get back to this, if you provide people, get those people back to whole, and essentially whole meaning both wages and employees, employee count, we believe by June 30th, that we, and essentially money expended, and it's expended to the extent that you use those loan proceeds within that 8-week period, that you'll be available for the loan forgiveness. This all being said, many of these procedures, or not procedures, but the applications, one, we need to go through the loan application. But secondly, there are many records that we're going to have to show on the back end after the 8-week period to indicate that we are in compliance with the forgiveness, and after that 8-week period. Moving on to the reduction in employees. Again, this might be an intricate calculation, but really what we're doing here is if you have a reduction in employees, it's really a pro rata based on the number of full-time employees. You have an option or an election. Let's call it an election. But you're able to calculate the average full-time employees for each pay period falling within the months that are described above. And these two items, I'm sorry, let me go back. And the items here where we say divided by. So there are two factors, and we'll have there's a calculation here that we can go forward with. Or an example, business A had 10 full-time employees during an 8-week period, and it borrows $250,000, kind of in line with the example previously. During the period of February 15th to June 30th, 2019, it had 16 employees, just as it did in the prior, just as it did from January 1st, 2020 to February 29th. Because there was a reduction in employees, there's a reduction, because there's a reduction in the employee force, then the loan forgiveness is reduced by the amount of employees that they reduced it by. That being said, we can see this as we'll go forward. There is also an additional component, perhaps, if you reduce the employee's pay. As I mentioned previously, we also can, if employees were furloughed, or if they're rehired even prior to this act, and we get them back into, let's say, just for lack of a better term, make them whole through that period for the previous wages, we believe that the forgiveness can be encompassed, or at least the look back period for the wages can be encompassed in the loan forgiveness amount. So let's go to the employee's pay. So this may be essentially where you have a reduction in employees and or a reduction in employees' pay. So the amount of employees' reduction in salaries or wages is in excess of 25% of the most recent full quarter of the payroll period prior to the date of the loan. Not all applicable. It's not applicable to all employees. It's applicable to, let's see, not applicable to employees with annual rate of salaries greater than 100,000. And we didn't really get into great detail about that calculation from the payroll protection program, but there is, Denver did speak a bit about, there is a cap about $100,000 of a cap on employees in excess of 100,000. So we'll go through an example of the reduction in employee pay. X is an employee of a business A, earned an annual salary of $40,000 as of the first quarter of 2020. After business A takes out the payroll protection program, X is, after that, they reduce the salary to $20,000, him or her. This is greater than the 25%. Additionally, it's 50%. That's the forgiveness amount of $210,000 based upon our previous example is reduced by another $20,000. So what we have is a total forgiveness of $111,250. So we started with, and we can kind of circle back, is we had $250,000 of, and look through the slides, $250,000 of payroll costs that were eligible for the loan proceeds. We identified 210 of them as that we potentially could have forgiven. Well, 78,750 was related to a reduction in salaries, and then additional, 78,750 was related to reduction in employee force, or at least number of employees that we had employed for the previous 12 months. And then 20,000 was additionally reduced for amounts related to reduction in pay. Again, these are simplified calculations. As we could get in, a number of people could get into macros and number of items in spreadsheets to try to determine what the proper calculations are. This is really a simplified arena of just kind of giving a 30,000-foot view of what we see as the calculation of payroll costs, and also including some items that would be in respect of the forgiveness portion of those the PPP program. So I think I just did that recap that we have on board here, but also the last item at the bottom, the companies have up until June 30th, 2020 to restore full-time employees and salary level to any changes made between February 15th and April 26th. That being said, there are loans out there under the payroll protection program of $359 billion. But those are out there until they are exhausted. So our recommendation is to get in front of your lenders, the banking relationships you have. Most of these items for the PPP, bankers would like to have a prior relationship with many clients prior to taking these on. But I would reach out to your LGT trusted advisor for help. And if you don't have a trusted banking relationship, that we can help you in that. And again, the idea is to get out there sooner than later. I know there were some questions about, at least I've seen some questions about, well, today, April 3rd, we were going to have these loan applications up and ready. I think there is some delay in some of that. So documentation needed for forgiveness, I would check with your loan provider from that standpoint. They're ultimately going to be the people who provide you with the clarification, verification of the loan forgiveness. But many of those items are going to be payroll costs, which the guidance came down on, which I mentioned previously, that 75% of that, they have directed that 75% of that needs to be directed towards payroll costs, with the remaining 25% being non-payroll costs, which would encompass mortgage interest payments, covered rent payments, and covered utilities within the eight-week period following the loan, once the proceeds are dispersed. So that's really what I have from this standpoint. I know some of us, we have talked a little bit about the IDL, or I'm sorry, the economic injury, the loan, disaster loan. So go back, just kind of comparing the two loans. The payroll protection program, it's really you can have up to 10 million, but it's really 2.5 times the payroll costs. The EIDL, which is the economic injury disaster loan, is 2 million, and it doesn't have a forgivable loan portion. I'll go back to the original slide that kind of provides you with a comparison of the two loans. So both of them really qualify for individuals with, or not individuals, but companies or sole proprietors with less than 500 employees. One unique opportunity for the EIDL is a $10,000 advance grant that can be provided upon loan application. It should be provided within 72 hours. And if you do apply, or if you are available for the payroll protection program, it may be able to be rolled into that program. But again, the big difference between the two programs is under the PPP program, if you can keep within the parameters, the items, most of the items can be forgivable or have some portion of them to be forgiven, have forgiveness. Under the economic injury disaster loan, there is no forgivable portion except perhaps for the $10,000 grant. So you can kind of look at the slide in slide 3 to kind of compare the two. I do want to kind of provide in summation that, and we'll probably have somebody discuss it maybe after I wrap up as to what further guidance. I know there's a lot of questions out there, and then some of the questions have been answered as we're going on. But I think after we finish up the webinar, we'll try to attack all the questions that are presented and try to give you the best response that we have as we know. Again, based upon I think there's an interim final guidance provided last night to provide a 30-day commentary for people to respond to the SBA as far as the loans that are out there, or at least the regulations that they kind of finalized in the interim position last night. So I think, as you may understand, we're all in flux, and we're trying to help our clients and everybody in the right position to get them in front of their lenders and to have the best information that we have to make them, allow them to have the information they need to kind of go forward. So for me, I appreciate you guys attending the conference, or at least the webinar, and I will bring it back to the moderator.
All right. Well, this is Colin again. I'm here to kind of work through helping with Q&A. So as many of you have seen, that we've gone through answering some questions that you all have had within the question and answer module. I'll open it up to myself and the rest to chime in with questions that we have seen that we would like to go ahead and add some clarity to. So Matt, Denver, do you all have any particular questions you'd like to start out with?
I can mention one. I noticed one of the questions was about the payment to independent contractors. Does it qualify as payroll cost? In the guidance that came out last night, if you're a business paying to an independent contractor, you do not get to include that in your computation of payroll costs. What the slide could be read a little confusing because the self-employed people would include compensation, commissions, and self-employment income up to 100K in their calculation. But any businesses that's paying independent contractors, you would not include that in the calculation.
Hey, Denver, this is Matt Peck. Could you go over, I know you did, but the thoughts on the payroll period for the calendar year 2019 versus the fiscal year in March 31, 2020?
Sure. Could Katie, could you go back to or if I have control of the slides, I'll be able to go back. Okay, thank you. It looks like the slideshow canceled out.
Sorry.
But we'll try and get the slide up Okay, so when the law or the act was passed, it states that you need to calculate your average monthly payroll of the last 12 months from the date you received the loan. So most people are going to get the loan in April. So you would think it would be the prior 12 months would be April 1st, 2019 to March 31st, 2020. The confusion, though, is on the application and the instructions. It states that most applicants will use the 2019 payroll costs. Then last night, in the guidance that was issued, there was a section that was specifically speaking to lenders, and it stated when you were gathering the information from applicants, use the preceding calendar year's average monthly payroll costs, which would be 2019. So this is something you should speak to your lender about, but it does seem like there's an opening to use the 2019 just based on the instructions and what was published last night, to use January 1st, 2019 to December 31st, 2019 for doing your average payroll cost. But if it was me, I would run the calculation for both and then see what is more beneficial for getting the maximum amount of loan amount. And then I would go to the lender and provide them that information and see what they say. Because the information that Ryan went over as well, just to go back to all this, you're applying to the lender. They're going to verify all the information, ask you for any additional information that they need, and then they will be the ones that are approving any of the expenses that you're requesting to go into the forgiveness calculation. So if you're going to apply, say today, and you're questionable about some of the different expenses that go into payroll, average payroll monthly costs, what I would do is I would just add a separate line item for items you're not completely sure about and just list them on your calculation and submit it to the lender and see what they say. Because there are some items where we don't have the answer on at this point.
Yeah, let me see. There was also a question, a couple of questions asking about what makes up utilities. And per the details, it indicates that electricity, gas, telephone, internet, water, and transportation would be eligible utilities in the reimbursement or forgiveness component of this PPP loan.
Okay, so there's a question, is the loan considered taxable income? The forgiveness portion, what's out there right now, states that the loan will be non-taxable, the portion that's forgiven.
I had a question that came up, Denver. If you don't currently work with an SBA lender, what are the best steps to go to try to find that SBA lender that you could potentially work with for this loan?
Colin, you might want to jump in on that, but what I've heard is you should probably try and go with someone that already knows you.
Yeah, my
And
understanding in talking with most of the lenders is they are so overwhelmed with working through applications that they've made decisions that they are accepting and processing applications for current customers only. Those current customers, in some cases, you need to be a borrower on a loan. In some cases, you can be as little as a deposit, as a person with a bank account. And so we would highly recommend that you do reach out to your existing bank relationships. And then if your existing bank is not an SBA approved lender, probably your best bet is reaching out to community or smaller banks and see if you can get in there. You certainly don't want to kick the can down the road a ways, because we might be looking at funds running out, because this is certainly one where it's significant amount of funds that are available, but in the grand scheme of things, not enough for all small businesses.
Here's one. If an employee makes 150,000, can we use the first 100,000 in the calculation? Yes, you can. It's anything in addition to the 100,000 you would not be able to include in the calculation. Can bonuses be included in the payroll calculation? Yes, I believe so.
There was also a question that was asked about if you were in the startup process of getting your business up and running, would you qualify for the programs? The programs do require that you're in operation by February 15th, 2020. So the answer, unfortunately, is no.
Here's a question. For forgiveness, do you have to use the funds within the 8-week period? Because remember, when you get the loan, let's say you got the loan April 1st, the 8-week period starts on April 1st. And whatever expenses are paid within that 8-week period will go into the calculation of figuring how much the loan can be forgiven.
Hey, Denver, I'll ask the question. I've got a thought on what our response is, but I'm not sure. But from the piece that came out last night, and it's talking about the things that were expressly excluded from the definition of payroll costs, and then that the 3 little I's, federal employment taxes imposed or withheld between February 15th, 2020 and June 30, 2020, including employees and employers' share of FICA and income taxes required to be withheld. I hate to throw you a zinger.
All right, I will tell you what my belief, and ultimately, remember, it's the lender that is approving all this. So you need to speak with your lender on this as well. But I believe if let's say you're going to apply for a loan, right? And it says you need to look at the past 12 months to figure out what your average monthly payroll costs were. Let's say you're using 2019, all of 2019 as your average monthly payroll cost, and you come up with a number. What this is stating is it's talking about federal employment taxes imposed or withheld. And let me go to the slide real quick so people can see what I'm talking about. Okay, it is talking about federal employment taxes imposed or withheld between February 15th, 2020 and June 30th, 2020. So my belief is on the front end, when you're applying for the loan amount, this is not going to apply. But then on the back end, when you're requesting or basically showing documentation for what expenses you want to qualify for the reimbursement, I do not believe FICA, which includes Social Security and Medicare, or the employees' withholdings would count. Because usually people are going to think you can use gross pay as what will be essentially forgiven, but it doesn't seem the case based on right here. It seems like it's going to be gross pay less than employees' portion of FICA and whatever income taxes were withheld on the employee's pay. So, which is kind of it doesn't really make sense, because if you go out and you're going to get loan basically on someone's pay, that if they're getting $10,000, you're going to get a $10,000 loan. But then when you're going back for forgiveness, that $10,000 is going to be reduced by the employee's share of FICA and whatever they withheld. And sometimes you don't even have control of what the employee decides to withhold. So it doesn't really make sense, but that's what's out there right now. Hopefully there will be more guidance, because that's before people start applying for forgiveness, that's a month or two away at least. So I'm sure there'll be something come out before then.
There was a question earlier that got answered that was, are the payroll costs calculated on a gross or a net basis? And I answered gross, and the response back was ADP is saying net, which, you know, looking at that clause, I mean, that essentially is pretty close to net for that period of time, but not, you know, obviously not for any time outside of that window.
A quick question for you, Denver. The one thing that popped up, if your compensation is already over 100,000 and that person's salary comes down beneath 25%, is the forgivable amount still 100,000?
Okay, so good question. When you're doing, let me go down to the slide that Ryan was speaking of. There's only certain employees that count when you're determining if their pay has been reduced by more than 25%. Let me go to the slide and then I can explain it, sorry. Okay, so this first part up here, the first paragraph where it's talking about the amount of employees reduction in total salary and wages, the definition of employee for that first paragraph is only employees that had, or only employees that received an annual rate of salary and wages. All right, let me start over. So any employee that received an annual rate of salary and wages greater than $100,000 for any single pay period during 2019 would not count as an employee when you're determining if their pay was cut by more than 25% in the 8-week period that you're doing the testing. So to answer your question, if they were already making 100,000 in 2019, and then in 2020 their pay was cut, I do not believe that will factor into the calculation and reduce the amount of forgiveness that they can qualify for.
There have been a few questions about use of funds that you've applied for, and then how to determine when it was forgiven. First of all, it is based, the 8-week measurement period appears to be based on the date that you actually got proceeds from the loan. And that starts the measurement period for the eligible expenses to be, to fall into the forgiveness piece. All right, are we about done with I think we're about done with our time. Are we done with our Q&A portion?
Yeah, there's still some out there that we will try to get to, but I think we've covered the highlights. I mean, we'll get to offline. Sorry.
All right, well, we appreciate everybody attending our webinar, and please look out for the link for the webinar that we're going to have next Wednesday, where we'll go over a lot of the new tax changes and fixes that came out with the CARES Act and other acts that have come out recently. Don't forget to complete the survey so that you can get your PowerPoint presentation. And please reach out if you have any other questions, and thank you for coming.
Thank you for joining us. As more guidance comes down from our government and the IRS, we pass that information along to you on our COVID-19 financial updates page. The link is in the description below, along with other important links, including our social media. If you would like to see more of the past Lane Gorman Trubitt COVID-19 financial webinar series, subscribe and hit the bell icon for notifications.